23 SL2 Corporate Finance and Risk Management paper. My name is Shankara Murthy. You may know, right? I've been lecturer for last 19 years at CA, actually IAS, the CA syllabus of financial management subject. So today we are going to discuss June 2023. It will be done in 2 stages. Actually, the question 1 and 2 will be done today, and probably next week we'll inform the day. The question number 3, because the question number 3 is a lengthy question where the pre-scene discussion had been done for CA Sri Lanka some time back. That's before your exam, June 2023. So the pre-scene video you have to watch before we start on discussing the question 3. So that's why we have wanted to break into 2 sessions rather than having it one go. So question 1 and 2 we'll be discussing. You could probably make use of the time to ask any questions where you want clarification or support, because the question 1, generally we say that the questions are there to score marks in your syllabus or the paper, because question 3 is a more comprehensive question and it is requiring your knowledge on most of the areas in one shot or one question. And then your pre-scene analysis should have been thoroughly done before when you are attempting the paper. So if you have not equipped to understand the question with all the knowledge and within the time, it may not be possible to get the enough marks. So the question 1 and 2 are the ones where it's 25 marks, but then when you break the question into many pieces, you get 4 marks, 3 marks, 5 marks, like that. So you are able to score marks in question 1 and 2. So generally my guidance, generally my students, I suggest always try to do the question 1 and 2 at the beginning and try to score marks. So we go take 25 means 50 marks we are talking, but there are many pieces of questions. So basically you are able to gather 30 marks. Definitely you can get 30 marks if you want to get through. If you get 40 marks, you are through without any doubt. But then 30 marks is something you can work for it. So I'm talking about the entire student base. So your 30 marks, question 1 and 2, if you try to get it, reasonably you get it, then your 20 marks only you have to get it from the question number 3 in terms of passing. So if you are looking at the price, if you are talking about more marks, very good. So you can try to get more marks, but at least you should be getting 30 marks from the question 1 and 2. That means you are talking about 15 marks out of 25 marks in the paper. So this is just a general guideline so that you also get prepared to attempt your paper in the exam all 3 hours. 1.5 hours you allocate for question 1 and 2, another 1.5 hours for question 3. Don't try to think that you do it very fast, question 1 and 2, 1 hour, and then try the question 3. Actually, it doesn't work like that. You are able to score marks provided you are spending reasonable time on that question, because that's how the question paper is set. So if you think that I can finish the question 1 and 2 in 1 hour, that's something you are missing. That means you are not writing sufficiently for the parts of the question they are asked. So please be mindful when you are attempting the question 1 and 2, and try much as possible to score marks. Score marks, unless if the question is totally unknown to you, the area is unknown to you, then you may lose the marks. But otherwise, try much as possible to get minimum amount of marks on each part so that you are reasonably equipped with your reasonable passing marks. Then you go to the question 3. Okay, so we will start the question 1 today. I believe all of you all have your question paper with you, because I'll share the paper, but then you need to, yeah, I don't know whether your screen gets shared with the pre-scene, not the pre-scene, the question number 1. Can anyone say whether you can see the paper? Students? Can anyone confirm whether you can see the paper? Yes, can see. Okay. So the question 1, look at the question 1. I'm sure like you would have read it already, but then just go slowly. It's about agricultural based manufacturing company. right? And it's a public company they are talking about. Actually, it's a listed company. And the primary objective set out by its shareholders to the board is given. So read that maximization of shareholders' wealth with a conservative level of risk taken. So that's their primary objective they have mentioned. I'm sure like all financial management student knows that primary objective of any corporate or any company is maximizing shareholder wealth. So this company also say as the same thing. Maybe they have added little bit more with saying that conservative level of risk taken. So in other words, they want to ensure the shareholder wealth is maximized with a minimum level or maybe a conservative level of risk for the business what they do. So that's something we need to discuss later. But understand that it's a normal primary objective of any company, it's maximizing shareholder wealth. Then they talk about the employee share ownership scheme, where the 10 percentage of the shares are owned by the employee share ownership plan, ESOP. So that basically owns 10% of the company shares. And then they give you the basic P&L I can't hear or see anything. Can I have others? Your comment? Now can. Okay. Can you see the suggested answer? Okay. I think maybe it's the time taken to convert from your question paper to the answer paper. So just look at the objective of the question is to find out whether you understand this wealth maximization point of view. So your shareholders' wealth is maximized by looking at the share price. So your share price is the best indicator whether your company shareholders' wealth is increasing or maximized. So how do we do that? So here, fortunately, we have been given the profit after tax. Actually, it is profit EBIT they gave. So we know that from EBIT to get the profit after tax, there are two items: interest and the taxation. So anyone, if you want to calculate your numbers, you can find out, right? So profit after tax is calculated. So if maybe take the first year, I just show you. Earning before interest tax is 217. Here, earning before interest tax is 217, and interest cost is 30, and income tax is 25. So you have income tax 25, interest 30. When you minus those two from your EBIT, then you get profit after tax. Are we getting 162? Students, can anyone confirm you are getting 162? Yes. So that is just to give you an idea that it is basically profit after tax computation from your EBIT, you minus interest and tax, then you get your profit after tax. So now we go back to the suggested answer. So that is the same thing you have to do for all 5 years. Then you get your profit after tax. Then the number of shares, as we mentioned at the discussion, it's the same amount for 5 years, 60 million. So you get a number of shares, 60 million. Then what you do, you divide the profit after tax by number of shares. That gives you earning per share. So when you get the earning per share, we need to find out what's the method of valuation we are looking at here in order to look at the value creation. So the earning per share is given, or maybe we have computed already. And they have given you PE ratio. So obviously we know it's a PE ratio means PE based valuation, PE based valuation. So you multiply the PE and the earning per share. And you multiply that, you get a market price per share. So it is clearly, it was mentioned, P ratio and earning per share, then you get a market price next line. Then the number of shares, we know that already 60 million. When you multiply, then you get your shareholder wealth. So 2019, your shareholder wealth is 810 million. 2023, your shareholder wealth is 1,792 million. So basically, we are talking about 810 million to 1.8 billion. 810 million to 1.8 billion. Now, can you all say whether shareholder wealth is maximized? Can students answer this? Whether the shareholder wealth is maximized based on the market value of the company shareholders. Others? Can everyone see whether you understand that basic? It's a basic thing, but we have to show the examiner that we understand how to calculate the market value per share and how the total shareholder wealth is looked at. So it's basically we understand shareholder wealth as created or maybe the maximized over the 5 year period. Okay, for over the 5 year, 810 million has gone to 1.8 billion. So that shows the shareholder wealth has been maximized by this company. What is the question they are asking? Whether the company satisfies the primary objective. What is the answer? What is the answer? Whether the company has satisfied the primary objective of the company shareholder. Can anyone answer? Students, hopefully you can hear. We can see the past papers. No, that's earlier we were showing the same paper, right? 810 million to 1,792. Can you see now? No? And there are few students says they can't see that. Can anyone confirm whether you can see the screen? Students, can you all see the screen? Yes, can. Can't. Can you all see now? I believe that all of you all have the access to your suggested answer, right? Even though its screen is shared, you may have your paper with you, right? Can you see now? No? We have the paper and answer with us. Very good. That's what I'm asking everyone. But there are people who are waiting for the screen to be shared, right? So that's why I asked whether you have the paper. Then I don't want to do. Even though I show it, you don't have to worry because you have the paper with you. So if you have the paper, can everyone see if you are having the paper with you, or if you can't see the screen, right? It's from the paper what you have. See 810 million, your 2019 value, market value, it has become 1792. Do you see the value created? Can you confirm whether you see the value creation? Yes. Yeah. So that's basically I say the 5-year period, the company has shown the satisfy the shareholders by creating value, right? So get created the value for shareholders. So that's your Roman number 1, 5 marks. Now, this calculation is not though difficult. It's basically the number of share multiplied by your market value per share and earning per share. What is the paper we are discussing? Thank you very much. 2023 June. I don't know whether Zoom, when they send the link or when they inform the class or the discussion, it is 2023 June. Okay. Yeah. So Roman number 2. Can you all read the question? Roman number 2. Roman number 2. Can everyone read the Roman number 2? Director in charge of the employee share ownership plan has reached out to you in light of the upcoming right issue to check whether it would be a good idea to exercise the rights by using employees' personal funds to maintain the same percentage of ownership and thereby continue to represent the employee voice in management decision making. Explain your viewpoint to the director on the above matter with your suggestion. So, what is the question they are asking? If the employees wants to have more say or they want to voice their opinion in the meetings, they think that they should have more shares. In other words, in the right issue, when the company go for right issue, it is suggested, the director in charge is suggested that we should go for right issue. That means employees should be, even they want to go to buy the shares, they can do using personal funds to maintain same percentage ownership, thereby continue to represent the employees in the board or wherever. Now the question is asking, explain your viewpoint to a director on the above matter with your suggestion. So what do you all think? It's a good suggestion or not? You all can understand what I'm talking, and then you answer. Right? It's more than the number calculational thing. We suggested answer as a numbers. Try to see whether you understand the question. The question is there is an employee share ownership plan which owns 10% of the company shares, and there is one director, is the employee nominee director, who is representing the 10% ownership shares of the employees, and he is suggesting better we apply or buy right issue shares, buy the right issue shares by the employees, even using their personal funds, so that they will own the same number of shares or same percentage own of number of shares, percentage own in the company. Now, they are asking our viewpoint about this suggestion or the director view. So, explain your viewpoint to the director on the above matter with your suggestion. So, what is the answer? Do we think employees should buy the right issue shares? That is, in order to represent themselves in the meeting, should they get involved in buying the right issue shares? Yeah, students, what is your view? Should the employees buy the shares in this company, even using the personal funds, or they don't have to? No one is answering. When you say share ownership plan, it's a kind of a trust you create, and then employees, on behalf of employees, the employee share ownership plan as the ownership. And then in this company, they have one director who is the basically nominee director of the employees. So now question is whether the company shareholders or maybe the employees should buy right issue shares in order to keep their percentage ownership in the company. Thing is this, there's a place where they mention whether the employees matters are addressed properly or not matters are addressed properly. Anyone? Whether the employees matters or interests are looked after properly or not. Not addressed. Exactly, not addressed. So the question is, when you say you own 10% as employee share ownership plan, and still your interest is not that very much concerned by the management, is there any reason that you should be buying further shares? Where you're buying again more shares in order to ensure that your percentage of ownership is maintained. Because a right issue, if you don't subscribe, what happens? Your ownership get diluted. Please understand that. There's a right issue when you don't buy your entitled number of shares. For example, a company may say that for the 10 shares, you get 2 shares as a right issue. If I don't buy the 2 shares, my ownership get diluted. So that will happen. So if I want to avoid the dilution, I have to buy the shares. If I don't buy, then my shares get diluted. So basically the question is talking about your shares getting diluted if you don't buy. So do you buy the shares? The answer is since already the company doesn't concern about the employees' interest, your ownership doesn't make a difference because again still you are going to be within 10%. You are not going to go beyond. So therefore, it's no point. You don't have no point to buying the shares. One, second, using the personal money to buy the share is not advisable. As a company director, you should be not be advising anybody to say you take your personal money and buy the shares, because already the company's ownership, even though 10% is there by the employees, it's not looked after properly. The other thing is number of employees. Do you observe in the company the number of employees what they had earlier? 2019, it is 1,548 employees. 2023, how many employees are there? Anyone? 2023, how many employees are there in the company? 992. So 1548 employees become 992. So what does it indicate? What does it indicate? Does it mean the company not doing well? Company having problem? Because if you look at the revenue, is it revenue is growing up? Revenue of this company growing? Yes or no? Yes. Profits, are they growing? Operating profit of the company growing? Yes. So we know that revenue growing, profits are growing, but employee numbers are reducing. So what could be the reason? Not treating the employee well. But please understand, if you are not treating the employees well, will your revenue grow and profit grow? It doesn't happen overnight. It's about 5 years we are talking about. For over the 5-year period, employee numbers are reducing, but revenue is increasing, profit is increasing. So what could be a sensible thing could be happening in the company? Anyone? Not generally, when the employee number reduces, you can say that employees are leaving the company. But in this case, I don't think it's the number of employees reducing because of anything else other than automation. Very good. I think people are understanding that, right? Efficiency increase. Yeah, maybe the efficiency increases, and automation could be the reasons why the employee numbers are reducing, even though revenue and profits are going up. Very important link is that. So we know that this company number of employees are reducing, but still profits and revenue increasing. That means could be the reason of efficiency and automation. If you say efficiency and automation are the reason, what is the purpose of we owning more and more number of shares in a company? It doesn't make sense. So that is another reason why we should not be increasing our number of shares as employees. Body should not be increasing number of shares. Third, the employees going to buy the shares of the company using personal funds. Now the question is, you are working in a company and you are going to take more loans to buy shares of this company. True that we owning some shares in a company motivates us and productivity increase and you also benefit. All that is fine. But then if you are saying the company is going to automate or already automating and reducing the number of employees, and you personally go and take a loan and buy the shares, what happens? Then when the company start automating further and further, you may lose your job. And you may not get the profits or whatever you're expecting from the company from the shareholding over short period. It takes longer period then. So that is what you should be concerned about, whether I should be owning this company shares even by taking a loan. So basically we don't recommend. One reason is don't buy shares further because there is no much interest of the company management with the employees. Second, automation. Third, personal loan taking may be a problem because if the company doesn't do well and the employees are being removed or terminated, then you lose the job as well as your own money. So these are the reasons where we have to say that director's view has not been or cannot be agreed upon because it will be affecting the company employees. So that is 4 marks question. So basically we don't agree with the director. Reasons are already discussed. Third one, Roman number 3. Can you read the Roman number 3? Discuss the suitability. Discuss the suitability of raising equity over debt under high interest rate regimes. Discuss the suitability of raising equity over debt under high interest rate regime and whether you agree with the company strategy to early settle debt with equity. Can you read the question again? Firstly, understand when you see the interest rates are becoming 10% to 30%, which means your finance cost is going to be 3 times of what you had last year. What was the last year finance cost? What was the last year finance cost we had? Very good. 45 million. So finance cost 45 million. If you say 10 percentage, yeah, you're right, 10 percentage, but the amount is 45 million. Next year, what will be the finance cost then? 135 million. Exactly. So it's 3 times of your last year finance cost. It's going to be triple. So you know that finance cost is going to go up significantly. So in this situation, you owning or you having capital to finance your business, debt capital or equity capital, which is better? Your capital structure knowledge, debt financing, equity financing. When you simply ask the question, which is better, what is the answer? Generally, please understand, I'm trying to just show you some theoretical aspects also here. Generally, if you are financing your company business, debt financing or equity financing better? Debt financing. On what basis? Exactly. I think someone is saying if the gearing level is lower and your business is profitable or your return on your investment is more than cost of debt, return on investment is more than cost of debt. Please understand, someone has to take tax shield, all that. I'm with you. But then more than that, your gearing decision making always have a simple question whether your return from your investment is more than cost of debt. If your return is more than cost of debt, yes, you should finance through debt financing, provided your gearing is within the reasonable level. So, what is the reasonable level? Generally, the maximum gearing you should go is 75% levels. It's just a guideline. So, don't go to 80%, 90% gearing. That means you are running a big risk in your business. But 50% 60% is not a harmful problem or issue, because that will definitely make more return for your shareholders. So, that has to be understood by us. So in this case, this company is a profitable company. We have looked at it, but then still they are asking whether they should be using shareholder money or debt holder money. So how do I answer this? So in order to answer this, can you look at your suggested answer? Suggested answer. Can you look at it? You are given EBIT. We don't have the capital structure. We don't have the balance sheet capital structure in this question. But we are given the EBIT and the interest cost. So when we have EBIT and interest cost, what we can calculate? EBIT and interest cost, when we have, what we can calculate? Very good. Interest cost and EBIT, we can calculate interest cover. So you can look at the suggested answer. 2019, your interest cover is 7.23. And 2023, your interest cover is 7.71. So if you take the last 5 years, your interest cover is in a similar region. So that in order to meet your interest cost, your operating profits are sufficient. Reasonably sufficient, because you have 7 times of interest cost as your profit. But 2024, assuming your same EBIT level maintain, if your interest cost become 3 times of last year, that is 135 million in 2024, your interest cover falls to 2.57. That means huge drop on your interest cover. So that is indicating that we are getting into riskiness or less riskiness. Can anyone answer? If your interest cover is reducing significantly, are you having more risk or less risk? Exactly. You are getting into more risk. So if you are saying that you are already having 10% interest cost becoming 30%, should we use debt financing or we should have equity financing and reduce the debt? What is the answer? This is your capital structure. I'm not looking at the exact number of the question. I'm just asking theory whether you are clear, because the examiner wants to make sure that you are theory clear. If you know our theory, you answer this properly. Based on the cost of equity, we have take the decision. Not really, because at this moment, please understand, in this case, the interest cost is 30% compared to 10% what we had earlier. It's an abnormal situation, because that's only last year we had that kind of cost. Like generally, you don't get a finance in minor market 10% becoming 30% overnight. But last year we added because we were in a crisis situation. So please note that this kind of significant change won't happen daily on normal situations, but it is happening. So as a company, should we use debt financing, continue to use debt financing, or we have to use the equity finance? As we know, cost of debt and cost of equity when you compare, which is cheaper? Cost of debt and cost of equity when you compare, which is cheaper? Cost of equity or cost of debt is cheaper? Cost of debt is cheaper than cost of equity. Please watch the capital structure knowledge. Please gather. Cost of debt is cheaper than cost of equity. Because otherwise, we will have to entire capital structure theory we will discuss. So please watch the video if you are following any class or even the CA Sri Lanka. The videos of mine have been there for each area. So please watch it. Cost of equity is always expensive than cost of debt because the riskiness in the ownership of the shares. So debt capital is comparatively lower risk to equity capital as an investor point of view. As investor point of view, cost of debt or debt investment and equity investment when you compare, debt investment is less risk to equity investment which is riskier. Therefore, the expected return of the investor also higher in the equity. That's what cost of equity is higher than cost of debt. Okay. So in this case, we know that cost of debt is becoming expensive, very much expensive. Then we are troubling ourselves. We are troubling ourselves. So what is the best way at this moment to find shareholders' money to reduce the debt? That is what this company decided to go for right issue. So please understand this logical sequence. Why the company go for debt to shareholders' money or the right issue? Because they understand 3 times of your finance cost, which is not at all acceptable or manageable by your company. So you are trying to now use the shareholders' money. So the question is asking us discuss the suitability of using shareholders' money over debt. So we have now discussed shareholder money at this point in time. Shareholder money is better than debt holder money, not because of the cost perspective, but because of you cannot manage your excessive finance cost. No point, no point. We all know that cost of equity is expensive than cost of debt, but these are exceptional situation. Ideally, we use the shareholder money to settle that bank borrowings of debt. So that's basically your one portion. Then we also have to mention, because we also have knowledge, shareholder funds have higher cost. When you say higher cost fund we use, even though your gearing comes down, your overall WACC, what happens? When you use more shareholders' funds and reducing your debt capital, what happens to your WAC? Exactly, your WAC goes up. So please note, second part of your answer, that even though we suggest to go for right issue, by going for shareholders' money or right issue, companies agreeing to increase their WACC, which indicates that your overall value of the company comes down. Because when your WAC goes up, your total market value comes down because it has an inverse relationship. So please be aware that we, even though as an answer we suggest for them to use equity funding, especially because of the higher finance cost, but that has a negative impact, which is your WC going to go up. So that is basically the 4 marks question, Roman number 3. Then move on to the B part of the question. Okay. So the Roman 1, 2, 3, it's about valuation chapter, and the what other chapter? What are 2 chapters in the first A part question they ask? 13 marks. What are 2 chapters? Anyone? Exactly. Valuation and capital structure. The 13 marks is for valuation and capital structure, including your basic fundamental of financial management. Then we move on to the B part. B part, if you are going through the question, I give you 2 minutes. Can you read the B part? It's about a freight forwarding company, largest freight forwarding company having overseas offices, Japan, USA, Africa. Due to COVID pandemic, freight forwarding industry has seen a freight rates going up 3-4 times. So we all know that during the COVID period, the rates have gone very much high. right? So that they have mentioned. Company eyeing the lucrative African market and evaluating to acquire a freight forwarding company. So it's about acquisition they are talking about. They are going to buy African company. So the purchase consideration relies on productivity and reach to different global market instead of tangible assets. So please understand these are more service industry, more than the assets. It's the business volume and the cash flows. So it's more of a cash flow based thing than the physical assets. So we all know that net asset basis is not at all a valuation method. We should give prominent in any question. Even here, it's very clearly mentioned the companies more than net assets, the cash flows. Then, when you read further, they are given you the company is planning to invest $50 million to acquire 100% shares in a company. Again, this is valuation related. 50 million they are talking, 100% ownership, and funded equity. This is to be funded entirely by debt borrowed at 5.5%. So that is the finance cost or the cost of capital about your investment. Then they give you the cargo tonnage in metric tons, 1 to 5 years, air freight, ocean freight, how many volumes are going to be traded or transacted, and the charge. Because in freight, you should know that whether it's ocean freight or uh, sea freight or the air freight, whatever it is, depends on the number of kilos or the metric tons you carry, you get commission. That's your charge to carry. It's like a normal transportation system where you carry the luggage or the volume. Based on that, your revenue is decided. So they are given two tables. One table gives you the number of kilograms you are carrying. Second table gives you the per kilogram rate. So when you read these two tables, your mind should be now knowing what I'm going to calculate. You are going to calculate the how much the total value of the quantity you are carrying. Then they give you further information. The 10% air freight commission, 5% ocean freight commission. So basically, the value of the kilograms you are carrying multiply by 10% and 5% will give you the your commission. That's your income. That's your cash inflow. Then they talk about company needs to remit the remaining to the airline shipping. That is basically your remittance to the your owner of the ship or the aircraft owner. Then they are talking about assume that commission rates remain constant over next 5 years. Then the staff cost. Now see, these are the other item by item they are giving. Staff cost is estimated to be $1 million per annum, year one, and this is expected to increase by 10% year on year. So we know definitely freight commission is our income, and staff cost is our first P&L item or the cash flow item minus, but it goes up by 10% every year. Then the depreciation amounts to $175,000 per annum on straight line basis. Company does not envisage any material addition over the next 5 years. So that means depreciation constant. But we are not very much bothered about depreciation generally because depreciation is a non-cash item. So in our cash flow statement, we don't consider the depreciation, but maybe sometime we have a usage later on. We'll look at it. Marketing and distribution cost amounts to 0.25 of the freight commission. So we always know that your cost could be the marketing or sale cost could be a percentage of your revenue. Here again, that same thing is given 0.25% of freight commission. Then utilities amounts to approximately 2,500 per month. So you multiply by 12, that gives you annual utility annual cost. And that again goes up by 5% year on year. Afro logis tax at 24, that is the tax rate. Assume that the increase in working capital per year is around 5% total freight commission per year. Now see, the working capital you have to invest every year is given, which is basically 5% of your total freight commission per year. So that is the basis of your working capital calculation. So each year, your working capital will go up by the respective year revenue, 5% of the freight commission. So basically, that is the working capital investment. We'll come to that when we are looking at the final numbers. Beyond 5 years, the net cash flows are expected to remain the same as year five forever in the future. So that's basically a terminal value calculation. Assume that capital allowance equals depreciation. Now see, why the depreciation was given? Not for cash flow statement calculation, but for our tax computation. Now read the question. Based on the NPV, Based on the NPV, we determine whether this investment in Africa is feasible in dollar terms at a discount rate of 10%. So the examiner has been very kind enough to tell you that we are simply asking you to calculate NPV of this project, not the valuation they are talking about, NPV of the project, discounting at cost of capital of 10%, and you are valuing or you are doing the NPV calculation on the what? 10% discounting NPV question they are asking. Now, can anyone say, is it difficult? If you know your investment appraisal from grade 11, right? Investment appraisal, you would have done it from grade 11. Just tell me that in this investment appraisal is difficult. So, thank you. Someone has at least bold enough to say immediately, yeah, it's not. So that's what I would say, that 25 marks of the first two questions generally try to give you marks. Try to give you marks. Not that you have to earn the marks, they give you marks. Question number 3, even if you want it, they won't give you. That's the difference. So first two question, try much as possible to score more marks. Right? Within the parts, there may be some unknown things that we don't worry much. But majority of the things you can score. So now we go to the suggested answer of your investment appraisal. Your simple investment appraisal. Can you look at it? Firstly, the examiner wanted to, when they give you marks, please understand this principle properly. When they give you marks in any question, they will make you to spend more time to get that marks. It's not difficult. It's not about difficulty. It is the number of minutes you spend to get each mark. Because examiner makes sure that this question is easy. Investment appraisal, very basic investment appraisal. Even A level student can do this part. But whether you do it very fast, that's important. Because there's nothing much here. The question is very straightforward, but takes time. So now we look at the answer. Investment how much? $50 million. Very clearly given. Right? Then we have to understand how many kilograms you are carrying. Air freight metric tons are given, 1 to 5 years. You just replicate the numbers. And air freight charges per kilogram charge is given, or metric ton. You can calculate the number. It's given there. Then the air freight revenue. Multiply your freight kilograms with charge. So that gives you air freight revenue. Then you are entitled to commission. How much commission? Air freight 10%, sea freight or the ocean freight 5%. So that table basically gives you the calculation of, actually the examiner could have done that as a working, but they have shown it in the cash flow statement itself. Ideally, it should have been done as a working and find out how much commission you get for air freight and the sea freight. So that gives you the commission amount for each year. Then you get a total freight commission. So the cash flow continue. Total freight commission each year is given. Next item, staff cost. We looked at it, $1 million year one, then it will increase by 10% every year. So that you can see simple inflationary impact, staff cost. Marketing and distribution, they clearly mention it's a 0.5% of your marketing revenue. That's your marketing and distribution cost. Utilities, as I mentioned, $2,500 per month. So what is the annual cost? Anyone? 2,500? $2,500 is the utilities cost per month. So what is the annual cost of the utilities? No one is answering. $2,500 per month. That's your utility cost. 1 year, what is the utility cost? 30,000 exactly. So it's very simple, right? So you know that utility cost every year that also goes up. That also goes up with the inflation effect. Then movement in working capital. As I mentioned, the working capital is, they have mentioned that your freight revenue, right? It's basically we are talking about working capital is 5% of the total freight commission per year. So you have to calculate 5% total freight commission. That is your increase in working capital amount. So you can double check your numbers. So that gives you the working capital investment annually. So already we looked at the capital investment, $50 million. Working capital investment is annually happening. that is also we can calculate by 5% multiplied by your total freight commission per annum. Then you get your tax rate. When you come to tax, we already mentioned that you are entitled to capital allowance from your profits. Working one. Can you look at the working one? Everyone, please. Working one. You have profit before tax and depreciation. From your profit, you must deduct your capital allowance 175,000, which is equal to your depreciation amount. So we can claim from the inland revenue from the profit we can reduce. Then that amount is entitled or not entitled. You are charging 24% tax. So that's basically given in working one year-on-year basis for 5 years. Then you get your net cash flows after tax. Then what do? You discount. At what rate you have to discount? Can I have? Sir, only the increase of working capital is taken. Yes, only the working capital increase is 5% of your total freight commission. They have mentioned that your 5% total freight commission is the increase. So 5%, whatever, it's only a basis. Yeah. Sorry, I think this getting disconnected in between, so don't worry much. It's again connecting. So what I was asking is, when you say the working capital investment, the working capital investment, it's always the incremental working capital amount. So in this question, they have given you the increase in working capital is 5% of your total freight commission. So again, don't get the gap between the 2 year working capital amount because the increase is the total commission 5%. So please take it like that. So then we ask the question, what is your cost of debt or the cost of capital for your discounting for NPV purpose? Anyone? 10%, exactly 10%. So we don't take the finance cost or finance cash flow in your investor appraisal because entire funding of your project is by the debt capital. They have given you that. Since the entire project is funded by debt capital, we don't take any financing cash flow into your project. Simply, we use the cost of debt, that is 10% in the case, to discount your question. So can you read that? They ask you uh, feasible. They want you to evaluate the feasibility in terms of a discount rate of 10%. So basically, we are discounting at 10% and we calculating the NPV of the project. So can everyone look at the answer? How much your NPV? And we have a terminal value also. After 5 years, you have a terminal value. How do you calculate terminal value? They have mentioned after 5 years, your cash flows will be what? Having growth or no growth? Anna 8 million. What is Anna 8 million? After 5 years, whether the company has cash flow having a growth or no growth? Yeah, remain the same. Exactly. Remain the same. So how do you calculate? No growth. If you have cash flow after 5 years, equivalent cash flow for the infinite period, that perpetual cash flow, you have to calculate. How do you calculate a perpetual cash flow without growth? Anyone? Exactly. Cash flow divided by R. Cash flow divided by R. So cash flow is 18 million or something. R is your 10%. So cash flow divided by R, that gives you 182 million. So you can see in your suggested answer, the terminal value is 182 million. Terminal value 182 million. Now you have got all your cash flows of year 1, year 0 to year 5, including the terminal value. Now we discount at the rate of 10% because they have mentioned that you have to evaluate your project appraisal using discounting rate of 10%. That's why I said this is like grade 11 question where the examiner is very clear and giving you the cost of capital. But at your final level, generally it shouldn't be like that. You have to find out your cost of capital. But here, fortunately, they are very clearly asking discount at 10%. So you don't worry anything, just discount at 10%. Then your NPV is under 8 million. Now the question is whether project should be acceptable or not acceptable. Can everyone say whether project is acceptable or not acceptable? Students? Yeah, accept. Others? Yeah, very good. I think that's very clear. Very simple question. So out of 25 marks in this question, how many marks do you think you would be able to get it? Any confidence, students? Out of 25, this question number 1, 10 marks. Out of 25, 10 marks. That means something wrong with you. 15, 20. Very good. I think if in this question, out of 25, you should be getting at least 20. Right? I'm not saying whether you are above the mark or below, right? Ideally, where it is mentioned about the terminal value, I think there is a line to say that they are going to get what? They are going to get beyond year 5 in the assumptions point forms, one before the last. Beyond year 5, the net cash flows are expected to remain the same as year 5 forever in the future. What does it mean? You have cash flow even after 5 years. That is the cash flow which will be used to calculate terminal value. So we calculated terminal value 18 million per annum. So we divided that by discount rate. Terminal value is cash flow. Yeah, since no growth, since terminal value is equal to cash. What you are saying? Terminal value equal to cash flow? No, no, no. Terminal value is the present value of your perpetual cash flow. Please understand that. Terminal value, present value, future cash flows. So after year 5, your cash flow going to be remaining constant. No growth. Therefore, when you want to calculate present value of perpetual cash flow, your cash flow divided by discounting rate or the cost of capital, which is 10%. So 18 million cash flow will be there for infinite period. D divided by R in a dividend valuation model. You are not the dividend growth model, dividend valuation model. D divided by R will be the value. So same present value we calculate 180 million. That's basically your year 5 cash flow. So you can see the suggested answer, year 5. Anyway, you have cash flow. Year 5 terminal value, which is the year 6 to infinite period cash flows present value, which is 182 million. Once I discount all this cash flow at 10% discounting rate, another 8 million is NPV. So any questions before moving on to question number 2? Those who said that you get 10 marks, I think you need to do more work. Simple as that. Because if you are trying to get 10 marks from this question, I'm sorry that you won't be able to get through the exam. Because this is the bonus question. Right? Valuation, very basic valuation, PE method. And the capital structure, they didn't go to discuss so much. They just simply ask equity capital and debt capital. And when the interest cost is 30%, whether you should use equity capital or debt capital. Second. Then you are given a simple investment appraisal question. So only thing it may take time because of the multiplying the freight commission if the freight amounts. But other than that, I'm not thinking anything is difficult there. So can we move on? Any questions? Anyone wants clarification on any of these things? Okay, no one. Tax payment in same year. Yeah. Generally, I don't know. Maybe if you have done exams in other ACCS SIMA, right? If you have not done those things, I don't think any of the time we will have in my financial management paper. I think never we had a problem with when the tax is paid. The assumption is always when. Anyone can answer this? What is the assumption? If you have looked at many papers of Charter CA FM paper, same year, same year. It's not postponed. It's not postponed. Even though we know genuinely it's the next year only we pay. But our assumption is always end of the year. Yeah. That is any cash flow is end of the year. But tax is paid same year or next year. The question comes because your March year and November 30th when you're paying me next year. Right? So please note that it's always the same year assumption. Right? Same year assumption. Unless the examiner tells you that current year tax is paid next year. Then you take it next year. Otherwise, its assumption is same year. Okay. So now we move on to question number 2. I believe that question 1 is clear. Question number 2. Can you read the question number 2? I give you 2-3 minutes. Can everyone please read the question number 2? So it's about you are a financial analyst, like a consulting company, and you have been approached by one client to investment. It's about investments. So they have given you two choice. One is investing in shares, common stock. They mean is shares. The other one is the bonds or debentures. So basically, they are talking about asset type 1, common stock, and they'll give you the information about the company. It's a 50-year-old company in the share market. It's a PLC, so it's a definitely listed company. And financial statement of the company basically says that common stocks market price is 125, earning per share last year 25 rupees. So please note that earning per share is 25, market price 125. What is the PE times? What is the PE of this company? Very good. So we know that because just now we talked about PE ratio valuation. So here may or may not be relevant, but just when you look at numbers, your mind has to quickly work. Price, market price 125 and earning per share 25. So that means the share is trading. Share is trading in the market, stock market at 5 times. 5 times. Right? Then chairman's message and company report made the following assumption on the future cash flows associated with the investment as well as the market. So can you look at that? The company expects to increase the payout in coming years as the company is planning to relax its aggressive investment policy in new ventures. Company currently maintains a payout ratio of 50%, which someone expects to increase to 60% at the year 1. In year 5, it expects the payout ratio to be settled down at 70%, then continue at this rate they are onwards. Now, when they are talking about dividend payout, how the dividend payout is working out, I'm sure like everyone knows how the dividend payout is calculated. Can anyone say dividend payout how it's calculated? Dividend payout ratio. How it get calculated? Students, dividend payout ratio? Dividend per share divided by earning per share. Very good. Dividend per share divided by earning per share, or total dividend divided by total profit after tax. Total dividend divided by total profit after tax. So please understand that's how the dividend payout ratio is calculated. This when we read this paragraph, our mind has to immediately work out, get into mind how to calculate these things. Then they talk about historical financial report. Return on equity has been rather stable. Return on equity has been stable due to the prudent experience, top management of the company, and it's 20%. So return on equity is 20% at the moment. So they have given you return on equity 20%. And they say that same return on equity will be remaining in the future also. So that is basically given. Then further they say the covariance between the return from the shares and the market return is 180 and variance of the all share index is 120. So covariance and the all share price index variance is given 120 and 180. However, expecting the company's systematic risk to revert to that market in the long run, someone thinks that taking 2/3 of the systematic risk of the security, 1/3 of the systematic risk of the market in determining the value of the security is reasonable. Now, entire this paragraph, it what area of your syllabus? Very good. CAPM. CAPM. So, if you have studied CAPM properly, what we talk about systematic risk and unsystematic risk, and how the market risk works, how the return on equity can return on market and return on the shares of the company can work, all that have some idea in your mind. And please note, CAPM area basically helps us to calculate cost of equity of the company or expected return of the investor. These two are same. Cost of equity and expected return of the investor are the same. From CAPM formula, we can calculate cost of equity, which is similar or equal to return expected by the investor. So please be aware, the question gives you that paragraph to give you an idea that they are talking about CAPM at some point in time. Then going on, the central bank reports, stock market report, 1 year treasury bill rate, how much? 5%. All share index is given at 5% and 15%. Yeah, treasury bill rate 5% and your market return 15%. So these two paragraphs actually will help us to calculate what? Anyone? These two paragraphs will help us to calculate what? Cost of equity. Thank you. Premium. Yeah, premium and finally cost of equity. Premium and cost of equity. So those who are not clear what we are talking, please go through the CAPM area and understand how it is calculated, what these variables are. Name, systematic risk. Systematic risk, what is the name? Systematic risk measurement is what? Systematic risk measurement is what? Excellent. Beta. So we are clear about it. Right? Those who have doubt on what we are talking, please watch the CAPM area, or you go through the CAPM area in either your own class notes or the study pack, and ensure that you are clear on that. Then we look at the type 2 asset. What is a type 2 asset? What is a type 2 asset? Corporate bonds. Can you read that corporate bond? Second type of asset company or Senuti is considering is corporate bonds, which is debentures. Please understand corporate bond, another name is debentures, with expectation of receiving a stable current income over the total investment horizon. Company accountant has recommended bonds of two companies. Two companies are in the corporate bond, the two debentures we are talking about. One is JK, other one is TG. Right? The coupon rate 9% per annum for 10-year JK bonds, whereas 10-year bond in TGA pays 10%. So there is a two bonds available in the market. Coupon rate is paid on the face value of the instrument. 1,000 rupees is the face value. You will be paying 9% of that. Other company, 1,000 rupee could be a nominal value, and you will be paid 10% of the face value as the interest per annum. So how many years? Talking 10 years. Then current rating, based on the current bond rating, the required rate of return for the both bonds estimated as 17 and 16. So please understand, from the investor point of view, based on the credit rating of the bonds, the required rate of return of the investors are varying. One is 17%, other one is 16%. Both bonds have face value 1,000, currently selling at 600 and 750 rupees respectively. So the second part of the asset story is about the two debentures, and they have very given simple bond or debenture where the nominal value is 1,000 or the face value is 1,000, and they pay 9% and 10% coupon rate, and 10-year bond, and both are 10-year bonds. And the expected return of the investors are given at 17 and 16, and market values are given at 600, 750. Now we go to the question A. Can everyone read the A part? Determine value of the financial securities mentioned above based on the given information, 9 marks. Can you please tell me what is this area of question? Let's understand that. When you read the question, you should know what is the area the examiner wants to test. Yeah. Cost of capital. Actually, the two types of assets are talked here. One is share investment, other one is bond investment or debenture investment. Right? So share investment is valuation of shares. Area is business valuation. Then debenture story is a valuation of bonds or the bond valuation. That's a debenture story. In order to do the calculation at the share valuation, we were to calculate what? Cost of equity. In order to calculate cost of equity, that chapter is somebody saying cost of capital. It's not really cost of capital, it's really the CAPM. Actually, CAPM help us to calculate cost of equity. So the cost of it's a one type of cost of capital, but the CAPM chapter only help us to calculate that cost of capital. So there are three areas being tested in these 9 marks. One is valuation of the shares, second is valuation of bond, third CAPM. Now we go to look at the calculation. Okay. So firstly, CAPM, they are using the CAPM model to calculate your cost of equity. So I'm sure all of you all know the CAPM formula, which is cost of equity or expected return of the investor. Cost of equity is from company point of view. Expected return is from the investor point of view, which is equals to risk-free rate plus beta within bracket market return minus risk-free rate. So that's how you calculate your cost of equity. So we should know the risk-free rate. We'll go slowly. Risk-free rate we know how much? 5%. And beta, we don't know, we have to calculate. Market return, 15%. So we know the risk-free rate and market return. Done. Then what do we need? We need the cost of equity calculation purpose. We need a beta. Beta mean what? It is a systematic risk measurement of the specific company. Beta is the systematic risk of the specific company. How do I calculate that? So firstly understand they have given you covariance and variance. So covariance and variance can be used to calculate the beta of a company, beta of the specific environment. So we are talking about this company. This company is having covariance of 180, variance of 120. So what is your beta? 180 divided by 120. That is covariance divided by variance gives you the beta. That is 1.5. Now that is unadjusted. Why they call it unadjusted? If you read the question, again I take you to the question. Can you read the question? Can we look at the paragraph? Regarding the CAPM, I told you to read that paragraph where they say, however, expecting the company's systematic risk to revert to that of the market in the long run. Someone thinks that taking 2/3 of the systematic risk of the security, that is the specific company systematic risk, 2/3, and 1/3 of the systematic risk of the market in determining the value of the security is reasonable. Now, they want to make it a little complicated, right? So, they don't give you exactly the beta you should take. Now, tell me, if you have done your CAPM knowledge properly, tell me, what is the beta of the market? Can anyone say that? What is the beta of the market? Please be aware. I think if you, I'm sure like any class where you follow, look at the CAPM tute or CAPM knowledge area, where you will see that beta of the market, beta 1.5 percentage is no market. It's not the market. 1.5 is this company. Always the beta of the market is 1. Beta of the market is 1. Because we are talking about comparing. It's a relative thing, right? We are talking about how the market behaves. Now, when you say beta, beta is measuring the systematic risk of a company, for example. So when I say the systematic risk of a company, how the market share, market that company market price vary or change for the entire market change. Entire market change is reflected through all share price index, for example. So how the all share price index change and the company share price change. If I say for one cost, if the government introduce a new capital gain tax, for example, how your market behaves, all share price index drops by 20%, for example. But one company, X company share price comes down by 35% or 40%. So what we are trying to look at, for the same reason, cause how the stock market price change, entire market average price change, and the one company share price change. So then we compare those, that will be the beta of that company. Same thing if you look at the entire market, both denominator and numerator will be the same. Then your beta is always market risk. Beta is how much? How much beta? Anyone? Beta of the market is always 1. Exactly. 1. So now we look at the answer. Right? So unadjusted beta, that is the relation between covariance and variance we calculated. That's the beta we have in the market for the company. This company beta is 1.5. But according to the accountant or the consultant, he basically says we need to take two-thirds. Someone is the consultant. Someone thinks that two-thirds of the systematic risk of the security. Systematic risk of the security is how much? Systematic risk of the security means that specific company. Systematic risk is how much? Anyone? 1. Systematic risk of the company. 120. What is that? Exactly. Systematic risk is the beta. So we calculated the beta based on covariance and variance relationship. We said systematic risk of the market, not market, the company is 1.5. Now someone, the consultant says we cannot take the 1.5. According to his wish, 1.5 is your, actually speaking, that is your company's systematic risk, beta. But without taking that, what is suggestion? Can you read that paragraph? Can everyone read that paragraph? Can everyone read that paragraph and tell me, if you say your systematic risk of one company is 1.5, according to this paragraph, how much should be the we are going to consider beta? Two-thirds of the systematic risk. How much is that number? Two-thirds of 1.5 is how much? Exactly 1. And market risk is 1. But one-third of the market risk. Market risk is 1. One-third of that. That is 0.3. So what is your total adjusted systematic risk? 1.33. Very good. So that is basically the suggested answer. You would see that beta 1.5 is that company specific beta, but the consultant takes not that. He is going to take two-thirds of that, one-third of the market, both together. Your systematic risk of the company become adjusted 1.33. Actually, it's bit of a complication, right? That's basically the complication the examiner wants to give you, right? Otherwise, it's a very straightforward. If you are saying that just a beta, you would have calculated cost of equity without any problem. But they want to give you some additional work by thinking if you can't identify in the exam all, you are finished. But then if you know covariance, variance calculation, you would have got that 1.5 and you would have got 1.33 also. Then CAPM formula you apply. According to CAPM formula, how much your cost of equity? 18.3. CAPM when you apply, it's 18.33. Okay, very good. So you got your cost of equity. Now we know how to value the share because we have got the cost of equity. Now we have to find out what is the valuation method we are going to use. What is the valuation method we might go? Now we are going to talk about share valuation. Yeah, dividend cash flows. So even though the table of the question give you another table, beginning of the period, equity, net income, dividend, retained earning, all detail, and assuming 100 number of share, I would personally say that it's not needed. Look at the second table. Second table. What was your earning per share last year? 25. And what was your dividend payout? 50%, which is 12.5. So we know the dividend per share last year. And what would be your next year earning per share? If you say your last year earning per share is 25 and dividend per share is 50% or dividend payout is 50%, then we know the dividend per share is 12.5. So what would be your next year dividend per share? How do you calculate your dividend growth rate using RB model? Anyone? With 0.32? What is 0.32? Dividend growth rate. Yeah. So you firstly will answer the your earning per share last year 25. Your dividend per share is 12.5 because 50% dividend payout ratio. So year one, your earning per share, I'm referring to the second table on the dividend and earning per share. How did you get 27.5? Anyone? 25 earning per share, how it became 27.5? Please understand, out of 25 earning per share, if you pay out dividend per share of 12.5, which is dividend payout of 50%, you retain how much? How much you retain? Anyone? Out of 25 earning per share, exactly. You retain 12.5. What is your return on equity always? What is your return on equity? 20%. Exactly. So your return on equity is 20% and your retention is 12.5. So what is your next year additional profit you will have per share? This is actually based on your RV model understanding. If you learn RV model, what we say is your retention multiplied by your return on equity will be the additional profit you will have for the next year. Additional profit. So if I say 25 is the last year earning per share, if I pay out 12.5 dividend per share, I retain another 12.5. That 12.5 invest and I will earn how much? 20%. So what is the additional profit? Exactly 2.5. That is why your 25 rupee earning per share year 0, 25 last year earning per share, next year will be how much? 27.5. Otherwise you won't be understanding how the 27.5 came. That is the earning per share for next year. That is RB model. Please make a note. It's based on your RB model where your retention multiplied by return on equity will be your new earning per share next year. Out of that, you pay 60% dividend payout, which is basically 16.5. So that table continues. Now, when you know your dividend per share year on year basis, what you can calculate every year, if you know the dividend per share, what you can calculate? If I know the dividend per share every year, what I can calculate? Growth, exactly, growth. So basically, the growth can be calculated each year. So actually, what is this model we are going to now use to value the share? In this case, the shares cash flow, dividend cash flows are given, or we have found to some extent. What is the model we are going to use? Dividend growth model. Any other answer? Please note that you have to be thorough with your theories, right, before attempting any paper. What is the model we will be using? Firstly, we have to understand previous or the question number one. We talked about valuation of a share to ensure the shareholder wealth is maximized. What is the method of valuation we used? Question number one. Question number one. What is the method of valuation we used to value the share? No one is answering. Question number one, not the question number two. What method of valuation we used? Dividend cash flow? No, 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 no. PE method, exactly. PE method only we used, method of valuation. Now this question number two, what cash flow method we are going to use? Question number two, we are talking about dividend cash flow. Now, under dividend cash flows, there are three sub methods. What are three methods under dividend cash flow? Yes, true, it's a dividend cash flow, but there are three methods under dividend cash flow. What are three methods? Know your theories properly. One is constant valuation model. Second is dividend growth model. Third, everyone talks about constant and growth. Exactly. Third one, two stage or three stage. That means many stages of your growth. It's not the one stage. 2 to 3 stages growth can be there. So if that is the case, we have to calculate present value of future cash flows of our dividends. Present value of future cash flows of the dividends. So can you now look at your dividend per share? We have already calculated each year how much the dividend we are going to get. Year 1, 16.5, it's going to 17.82, like that moves. So what we do, we calculate present value of these cash flows at the discounting rate and get the each year cash flows present value, and year 5 onwards it has a constant growth. So we use the constant growth rate model. That is what we have used to calculate the value per share. What is the discounting rate we use? What is the discounting rate we use? Anyone? Yeah, cost of equity. How much is that? We calculated. 18.33. Exactly. 18.33 is your expected return of the investor. That's why we use this CAP model, adjusted systematic risk, and got 18.33. So use 18.33 and calculate your present value of future dividend cash flows. That's your 2-stage, 3-stage dividend growth model. 2-stage, 3-stage growth model. Value of a share is 157.18. Value of a share is 157.18. Then that is your share valuation. What is the market price of the shares? What is the market price per share? 125. So based on dividend cash flow, your share is worth how much? Based on a future dividend cash flow, your share is worth how much? For the investor, based on the dividend cash flows, the share is worth exactly 157 rupees. But the market value is how much? Market price is how much? 125. That means your share is underpriced or overpriced. Very good. It's underpriced. Not overpriced, it's underpriced. Because the value is 150. That means worth 150, but 157, but trading at 125. So definitely it's underpriced value. So that is about share valuation. Now we go to the bond valuation. There are two bonds given. Very straightforward, simple bond. Please remember on the valuation chapter, whether it's a bond valuation or asset valuation or share valuation, anything, any valuation, we should be having a basic concept clear. The valuation point of view, even you personally, if you want to value yourself, your value equals to what? Anyone? Any asset. It can be building, it can be exactly very good. Present value, future cash flow. So even the bond, the logic remains the same. Present value, future cash flow. So please remember, when I buy the bond in the market, whatever price I pay, that's my price I pay. But what is the bond? That is present value, future cash flow. So if I take the what are the bond, JK bond or the other bond, my cash flow will be there for how many years? Cash flow will be there for how many years? Both bonds are 10 years. So each year you get interest cash flow. Each year you get interest cash flow. So year 1 to 10, I will get interest, which is the coupon rate. Coupon rate is calculated on the face value. That's the annual cash flow I will get. Apart from the annual cash flow, will I get any other cash flow? Apart from the annual cash flow, will I be getting any other cash flow? Yes. What the cash flow? Redemption value. Very good. Redemption value. So we are clear that apart from the dividend cash flow, we get the redemption value. So both examples basically given there. They give you the year 1 to 10, 90 rupees coupon rate or coupon cash flow. And year 10, you get the redemption value 1000. And your discounting rate is the required rate of return of the investor. And both bonds, required rate of investors are same or different. When I go to value this, I'm going to discount your future cash flow. So I need to know whether my required rate of return is same or different. Different. So my discounting rate will be one is 16, one is 17. When I discount value of the bond, JK bond, value of the bond equals to present value of future cash flow, which is 627 rupees. What is the market price of the bond? Market price of the bond is how much? 600. So share or like share, the bond or the market value, which is 600, whereas value of the bond using the future cash flows, it is 627. JK bond underpriced, overpriced in the market. Very good. JK bond is underpriced because 627 is the worth, but it's trading at 600, so it's underpriced. Now we move on to the other one. The other bond, can you calculate the other bond? TG bond. So TG bond, again here 1 to 10, 100 rupee dividend or the interest you get annually. Expected return is 16% of the investor. Same 10-year bond, but the expected return differs and the coupon rate differs. So what's the value of the bond? Value of the bond is 710. Value of the bond is 710. How much the trading price of the bond? Yeah. Now tell me this bond, not the JK, TG bond is underpriced or overpriced? Excellent. Yeah. So we are very clear that it's your basic present value concept, discounting your future cash flows. So we got 710. So out of the three investment types, shares, is it overpriced or underpriced? Shares, overpriced or underpriced in the market? Underpriced. And JK bond? JK bond, underpriced or overpriced? Exactly, underpriced. And TG bond, underpriced or overpriced? Yeah. So the first 9 marks, 9 marks. Can you read the question again? A part. A part of the question. Can we read it, please? A part of the question. Determine the value of the financial securities mentioned above based on the given information, 9 marks. So it's about, as I mentioned, valuation shares, dividend growth model, 2-stage, 3-stage model, and then we are talking about bond valuation or debenture valuation, which is simply present value of future cash flow. Present value of future cash flow. So 9 marks we have got it. Now read the B part. First part, A part is the value you have to calculate. B part, recommend to the Senate on how to select finance security as he could convince his partners to commit to the investment for the value determined above. Can you read that? So actually we have discussed that anyway, the 2 marks. That is, shares are underpriced, JK bonds are underpriced, TG bonds are overpriced. Therefore, what is a suggestion for us to invest? Are we recommending them to invest in all three financial securities? Are we recommending the consultant to? Yeah, very good. I think it's underpriced one only. Shares and the JK bond. Shares and the JK bond, we recommend them to invest. So that is about 2 marks question. Now read the third part, C part, 4 marks. Can you read the question? C part. Compute the value of total investment. Compute the value of the total investment 5 years from today. 5 years from today, if the forecast made today hold without any change, and Senut wishes to purchase 50,000 shares and 50,000 bonds. So they are talking about now not the today value. Now we did the valuation of the shares and the bond today value. Now they are talking about compute the value of the total investment 5 years from today. That means not today value, 5 years later. That means we are asking about what calculation? It's about the today value or 5 years later? Are we talking about today's value or 5 years later? 5 years later. Right. Now, it's not about you taking today's value and multiplied by 5 years of cumulative interest. That's not the way. Right. You need to again go on the same principle of the present value of future cash flow. The valuation beauty is that present value of future cash flows. So we'll value the common stock, that is shares. Can you look at your dividend per share, year 6 onwards? You know your dividend per share. Then you calculate your valuation. That's the present value of future cash flows. So that is basically the working one. Show you per share value. That means you are now not in year 0. You are in the 5-year end. So now your first year is which year? Can you all understand what I'm talking here? Yeah, we are not talking about year 0. Now year mean today mean year 5 end. 5-year gone. Now tell me, if I want to value a share or bond or anything, next year will be my which year? Yeah, year 6. Yeah, exactly. Year 6 will be your first year. If I take a bond, the bond, 10-year bond, I am now in after 5 years. How many years still to go? You will take the bond, 5 years gone. How many years to go? 1 year. 5 years. Your 10-year bond, 5 years gone, another 5 years. Shares, how many years? Shares, how many years we have? When we did the dividend valuation, dividend growth model there earlier, how many years time horizon we were talking? Very good. Excellent. Infinity. So now tell me, after infinity is no end for the period. 5 years has gone. You are in the 5-year end. How many years to go further? Bond, you all said 10-year bond, 5 years gone, another 5 years. Shares, how many years further? Again infinity. Again infinity. Right? But only difference is you are not in year 0, you are now in year 5. N. So your future is going to be starting from which year? Year 6, year 5? No. 5-year finished. Please understand that. 5-year finished. You are on the 6th year onwards your cash flow starts. So year 6 will be of which year? Your year 6 will be which year? When I am in year 5 N, exactly. Your year 6 will become the first year. Year 6 become the first year. Get that logic clear? Right. Now we look at your calculation. Can you look at the answer? So working 1 shows you dividend valuation. Year 6 onwards your cash flow, your discounting rate, that's your cost of equity minus G, that is DO1 plus GR minus G formula, dividend growth model, and value of your share. So you're valuing at the end of year 5. So the share is worth 225 rupees at the end of year 5. Then the bond valuation. How many years balance? 5 years. When it start? Year 6 to 10 years. Right? Then year 5 years time, that is actually year 10. They would have put it year 5 year, but actually it is normal time period, it's 10 year. But this second part of the question, it's a 5-year end you are going to get. And even the year 6 to 10 they have mentioned, it should be year 1 to 5, because year 6 onwards mean year 1 to year 5, the balance period of 5 years. Then you calculate your present value, that comes to 744. That's a per debenture value, and share is 225 rupees. So, and they have given you how many shares, how many debentures they are going to invest? Anyone? How many shares they are going to invest? 50,000. How many debentures? Exactly. So 50,000 shares, 50,000 debentures. When you multiply, you get your value of the investment, value of the bond investment, value of the share investment, 11 million and 37 million. 11 million and 11 million and 37 million. So that is total is 48 million you will be investing. 48 million you will be investing. So this is basically the question B, ABC parts of the question. Okay. So then the D part, before attempting D part, can you read the D part? So they have given you the environment with probability. Whenever we read the information with probability, immediately our financial management knowledge, we need to know what needs to be calculated. Expected value. Very good. So we should know that could be calculated. And in this area, the second part or D part, it's mainly onto your uh, portfolio theory area, where your mean, median, standard deviation, that kind of information is there, right? I would like you to refer your study pack, because this is the second time the examiner is testing on this area in the last 5 years. Detail study pack page 439. Study pack page 439. Study pack page 439. Please go through that area, maybe a couple of pages, 2-3 pages. That gives you the, actually this question is, I would say, like, to great extent from that area. That means basically they ask whether you are able to calculate your simple expected return and the relationship between the variables. So if you read the question, they wanted you to calculate the expected return and standard deviation of the return of the portfolio. So it's not about one share or one investment they are talking about. They are talking about expected return and standard deviation of the portfolio. Entire portfolio, they wanted you to calculate entire portfolio mean only two investment, expected return and standard deviation for you to calculate. Then they ask you if the Senate invest an equal sum of money in each of the financial securities, recommend in part B above. Okay, so you need to firstly calculate your expected return of the common stock and the bond, expected return of the common stock and the bond. I'm sure like you could see that in the suggested on the D part, the probabilities are given and return from common stock and return from bonds are given depends on the scenarios, because there are three scenarios they are given: growth scenario and stagnation, recession. So there are three probabilities are given. So we know that you have to multiply the probability with the return expectation. So when you multiply the expected return with the probability, you will get your expected value. That's basically the mean. That's the average return from your investment. So when you look at the answer, the average return is 8.4 from the shares and 7.2 from the bonds. And when we look at the portfolio, how we are going to invest in the portfolio? What is our portfolio going to be? Shares and bonds. How we are going to invest? What kind of amount? Yeah, right, equal 50-50. So we are talking about 50-50 investment in the portfolio. So if we are going to invest in portfolio 50-50, we should know our where average return of the portfolio is 50% 8.4, 50% 7.2. That gives you the expected return of the portfolio 7.80. That is your D part first answer. Your expected return of the two investment we calculated, average of that will be the 50 percentage of the expected return of both investment. So that's your first part. So I'm sure like nobody could have issue there, because it's your average calculation or expected value concept calculation where you multiply by the probability with your expected return. This is your portfolio theory area. So if you are not sure about what we are talking, please go through the portfolio theory area, because that will help you to understand how to calculate this expected value when you are given a probability. Then when you have two investments in your portfolio, how do I get my average? So that is basically here given 50-50 we are going to invest. So average is both returns of, you add it, that's weighted average. Here it's not complicated, it's 50-50. So when you add it together, you get your portfolio return. Then we are talking about variance of the portfolio or the standard deviation, right? So please note that that's why I referred your study pack also, so that your calculation can be done based on that formula. When you look at the standard deviation of the portfolio, it's 8.072. They are calculated. It's a detailed calculation. So these are time consuming, even though you may know, but exam all, it will take a longer time because there are a lot of calculation involved. So even if they are the formula given, still it takes time for you to calculate, because there are multiplication and the division and then square. There are a lot of calculation involved in these formulas. Then you get the standard deviation of the portfolio is 8.072. And weighted average of the standard deviation is 50-50, as we mentioned earlier. It's 8.074. So what we are trying to address, the last part, this calculation part is a D. E part is asking us, discuss the benefit of investing money in a portfolio using calculation done. What is the benefit of investing in portfolio? Any idea? Without doing calculation, your theory knowledge should say. When I invest in portfolio, otherwise when I invest more than one investment, without I am depending on one product or one investment, by diversifying, what is the benefit? What is the benefit of diversification? Exactly. Risk will be minimized. So in terms of number, you should know whether risk is minimizing. So please note your standard deviation of the portfolio is 8.072, right? So weighted average they calculated to say it is 8.074. Whereas your standard deviation they are calculated to show it is higher than your weighted average of the individual assets standard deviation. So that shows that by diversifying our riskiness, standard deviation also shows the riskiness. Your riskiness of the investment portfolio is lower than the individual or the one by one investment. You take that riskiness. So by diversification, we are reducing the risk. That's basically this question tries to prove us diversification reduces the risk. So this area, even though the starting, I would say 13 marks question, it was easier because it's a valuation chapter, bond valuation and the share valuation, 13 marks. But the last 12 marks of the second question is on your portfolio management. So if you are understanding your portfolio management theory properly, where you calculate your probability and the return and you get your expected return, and how to calculate your standard. First 12 marks, it's mainly on your valuation chapter. Second 12 marks or 13 marks, it's about your portfolio theory. So please note that this is how the question 1 and 2 had been structured. So overall, when you look at out of your 50 marks, how many marks should have got it with your present knowledge? If you attempted this paper out of 50 marks, what would have been your marks? Your confidence level. Whether you get that marks is examiner's hands. But what is your confidence level of attempting that reasonably thinking at the exam hall when you come out? You believe that I have got these marks. What is your marks? Anyone? 30. Okay. 35, 38, 36. Very good. You are believing that you have attempted more than 30 marks. So that's why I said your 30 marks should be earned in the question 1 and together. More than 20, 30 marks, if you are getting, it's good. That's what you should target it. But 30 marks, if you are getting, you have a more chance of passing because case study question, you would be able to get 20 marks because that's the rough areas. So you could score some marks. So definitely you get 20. But 30 marks you should get from the question 1 and 2. So as far as people who are not confident of getting 30 marks from these two questions, I think you are given another 1 month more for your exam. You to go through your theories first. The question 1 and 2 is simply coming from theories. Okay, so if your theories are stronger, then you will get your marks. It's not so complicated. Time consuming, time issues is a different issue. That is, anyway, you have to practice many questions to make sure that your time is enough. But otherwise, you have to know your theories first. Okay, thank you very much. So with that, we stop the question 1 and 2. As I mentioned at the beginning, question 3, we need another 1.5 to 2 hours. So I will be doing a separate session on next week. Whether Tuesday or Wednesday, that we'll decide and inform you. But definitely, you have enough time to clarify things from me, right, rather than just listening because it's not video recording. It's a online thing, so you can ask questions. So please go through question 3 with the pre-scene discussion already what I have done for CS Sri Lanka before the June 2003 exam. So it's in the YouTube channel. Please go through that and make sure that you are prepared before you're attempting your unseen material and go through that and we'll look at it next week. Thank you very much.